Hi, Face. How's everyone doing? Hello, Alexander, Richard Adams. How are you? Hugo, Ziggy. My mic wasn't on. Must have been someone else. Welcome back, Ryan. How are you?
Yeah, morning, Blake. How are you?
I'm Dale. It's okay. I'm not, it doesn't, but it's a compliment to me. I don't know how Blake will
Yeah,
feel
I
about
was
it.
I was speaking to Blake a moment ago. That's why I got Blake in
No,
there.
it's okay. You have old timers disease already. How
Yeah,
old are you, Ryan?
I can't remember. Um,
Oh yeah, I can't. You feel younger
48,
after camping
48.
trip?
Yeah, no, not much. No,
Okay.
I'm 49 next month.
Oh, yeah, you're a pup.
Yeah.
Okay, so I'll trade with you. I'm going to make a trade. All right, guys. So who's up for having a good week out there? I am. And it's the last full week of summer, I would say. And I think that volumes will return to normal. NFP this week, right? That's going to be a big number. Jays. Hi, Laura, Monica. So I want to start off with Euro. And I did say that to sell strength in the dollar after Powell, if it happens, pretty classic rally back to the breakdown in the Dixie. I mean, it really came off. So what do we have now? I mean, let me just do the narrative. Back here, both Blake and I didn't think this double top would hold, that people got too bared up over a consumer confidence number that we would break out, that it would then said it would be a false breakout, which it was, and that we'd have a dollar peak. My narrative was I think we could go to 91 over the coming weeks in the Dixie. That's about 61.8 back of the whole rally. So, this was a top pick that worked, and then nothing has changed. The only thing that has changed is if you're short the dollar now, you don't have to have your stops over the high of the move anymore, because this 20 area has definitely proved itself, right? It was a breakout. It was a failure. It was a test of the failure and heading lower. So a dollar still looks negative to me unless we could start closing back over 93.20 again. Give me a Y if you get it.
Why for me? Classic line, isn't
Y.
it, Blake?
Yeah, you got a Y? How about attendees? Scott gets it. All right. So anyway, and should that manifest last week when Blake was going over potential scenarios from Powell, strong dollar, weak dollar, I was talking about 119.5 euro. I see coming down the line, maybe 120. And if you look at this formation, this 1810 level is pretty key. Maybe we could fill out a little bit here, correct a little bit here, but closes over 1810 coincidentally with a low of what was the 1664. So, call it 150 is going to get you 1960. Hello, Dennis. And this for the dollar to turn good on a longer term basis, I'm going to need closes over 120. So between 119.5, 120, I think should be a battleground for dollar weakness up here against the euro. And so that's what I'm looking for in the coming days and weeks up here. But I think it's going to be a shorting opportunity for one more decline to Blake's major buying area, which comes in off this trend line down here around 113. So basically looking for, a pop, one more break, and this might be the break to buy euro for a long-term hold, instead of a trade. So that's my look. And I think what might be driving it is what's happening here. 10-year actually looks like to me that it's going to try and make a move to the upside and breaking out over 136. This was a 23 bip move. So a breakout over here is going to give you, about 160 on the 10-year, which would take it through real important resistance at this 148 level. Okay, this has really been a major pivot in the 10-year, but a measured move. Could call it an ascending triangle. something like this. And then I'm going to turn it over to the guys, something like this. So you got that flat line, and you have an ascending line and a breakout over that 136 level. Should give you some decent upside, and that should, which conflicts with, my view on yen, which, is lower. But, when I looked at the yen on the weekly, even though, I'm a little negative, see this weekly candle here really wasn't that bad compared to the dollar weekly candle, right? It's like night and day. So even though it's a dollar pair, it wasn't as weak as the dollar was. So, it's a kind of I don't know for me there. It's an I don't know for me in commodity currencies. I don't know if there's going to be another shot up. Anyway, what a surprise, stock indexes are making new highs here. Okay, 45.14. And, most time frames, even though we're at new highs, diverging for the 10 billionth time up here. But I'll tell you something about this divergence that's different, and I pointed it out last week. If you have to use your cursor to get an RSI reading, like between here and here, this divergence, if you need to get the measurement, forget it. Okay, even if it was a divergence by, a reading of a point or two, the divergences that are important are ones that you can see with your naked eye. Okay, so I mean, here we are at new highs, and that's glaring compared to these, right? I know I'm the boy who cried wolf. I cried wolf here, but we got a nice little break, cried wolf here, got a nice little break. You never know when.
Wolf. You didn't cry wolf. You didn't cry wolf. You cried like a baby.
Well, a baby wolf.
Big baby.
Big baby wolf,
Big baby wolf.
I'm the boy who cried wolf in baby talk.
I was going to say, but I mean, look, I mean, we've all tried to fight the trend at some point, especially in the S&P. I mean, it's hard.
I think that we should still fight it.
I think I told everybody last week. And I mentioned in the chat room too. I'm actually really proud of myself this whole year. I haven't been on the short side of the S&P. I'm like, screw that. This market is just, it's like, why fade it? But I do think that we're going to correct at some point. But man, you got to see the whites of their eyes, right?
Yeah, maybe you do it. You be Steve Volge and you wait for confirmation of it breaking, like 4,400 or something like that.
I think you gotta, you've got to here. So I mean, you got to wait. I know the trend line, and I was talking about on the week ahead video. The trend line does come in around 4,400. So it's like, why not wait for that level to break?
Yeah, and it's interesting how sometimes these moving averages could come in around the same area. I mean, the 50-day on this almost looks like a trend line, doesn't it?
Yeah, I mean, it almost does. Yeah, it almost does. But
even the 200 looks like it could be a trend line. If it breaks the 50, there's a lot of room underneath it. But anyway, I'm just a baby attempting shorts again this week in the S&Ps, and I'll let you know if I dirty my diapers.
Oh, if you're gonna do it, like when you're, and I try to explain this dynamic while being in a wedge. If you're in a wedge, you as we are, this is a big ascending wedge in the market.
Yeah, go ahead, show it, bro.
I can
take over the screen like the Outer Limits. Blake's taking over our screen or television.
So if you guys can see the ascending wedge, I mean, if you're in an ascending wedge, the way to trade it, if you're going to be on the short side, is you have to sell rallies. So, like today, obviously we're hitting highs. I mean, I would look for the upper end of this wedge to be
could
tested,
go there,
which is 45.50, right?
Okay. Yeah.
And let the upper end of the wedge get tested and then sell into strength. And then, if you're going to do it up here. I mean, this is where longs get caught. Longs they chase new highs, and then all of a sudden the market reverses, right? So and it pulls back to the wedge bottom. So people chase the highs now, like today we're hitting highs, and we might continue on throughout the week, as ahead of the non-farm payroll, and just sell rallies then.
What do you think the market wants on non-farm payrolls? A weaker number?
The stock market wants a weaker number. Yeah, I mean, keep the unemployment rate at, what is it? Was it 5.4%? Is that where we were at?
Yeah.
I think that's the number, and yeah, I mean, create 600,000 jobs. Show the market that we're still creating jobs, that the market's good, but it still needs some help. That's like the porridge isn't too cold, isn't too hot, it's just right. So you have the stock market that will appreciate a good number, but not too good of a number. So
thanks for telling me kind of like a child story.
Sometimes I have to explain to you like a baby. Hey, and I heard Ryan's voice. Is Ryan here?
Yeah, he's here.
Yeah, hi Blake.
Ryan, hey, welcome back, man.
Yeah, thanks, mate.
You got eaten by a bear.
Can you tell? I have Austin Powers. What's the Irish guy in Austin Powers, the bad guy? Oh no,
the Scottish, was it Scottish guy?
The Scottish guy. That's it. What was his name?
Fatback.
Fatback. That's it. I guess he could, right? Anyway, get in my belly, you big baby.
Hey Blake, what's your 10-year yield look like going into the Fed this week? I'm curious.
It's not. I thought we were going to break out higher, but I think it's stalling, right?
Yeah.
But I don't know. I mean, I don't know. Ryan, I'm not going to throw Ryan right into the fire now with I know he's been out for a couple weeks. There's nothing worse. There's nothing worse than being away from the markets for so long, and then trying to re-engage yourself, especially after a couple of weeks off and a couple of week hiatus.
I'll give him an easy one, Euro pound.
But no, I mean, I was going to say, looking at yields though, it's like I thought they were going to break higher, and it looked like we really were. And then the Fed chairman he wasn't obviously he just wasn't very hawkish. And so because of that, it kind of capped yields, but that doesn't mean that we can't break out this week. I think we need some help with the Fed, right?
Peter Bookvar said that Powell is so afraid of the shadow that my long gold position might finally start to work.
That's pretty funny.
Peter Bookvar, yeah,
that's pretty fun. Well, Ryan, since you were out a little bit, and you were out for a couple of weeks, and I don't know if you were actually here during Powell's speech. I think I can't remember if you got here after the fact or before. But what did you think about Powell and what he delivered there for Jackson Hole? I mean, do you have any thoughts?
Yeah, I mean, the good thing is when you go away, and this time I properly switched off. I mean, apart from checking prices, maybe once a day, I didn't hear Jackson Hole. I didn't read anything about Jackson Hole. And although you can miss out on things, what's good is when you come back and you've got fresh eyes and you can take a review of everything that happened and look at it and simplify it. I mean, we had a conversation this morning in the chat room. Basically, Powell did what Powell does. You got all the hawkish FOMC members and Fed members coming out, and he just reels everyone in. And that's basically what he did. I mean, before I went away, I said a lot of expectations going into Jackson Hole that perhaps is unjustified because it's not an FOMC. We had the FOMC, literally a week or so before for Jackson Hole, whatever it was. And so he's done his usual. He's come out and said, okay, fine. Inflation expectations or our targets have been met, but jobs haven't. So, and rates are miles away. So forget rates. Tapering may happen. It may happen soon. It may not happen soon. But he's constantly trying to keep the reins on it. It's like a dog owner with 15 dogs trying to keep them all from straining on the leash, and that's what he does. So the market goes, Powell's been dovish, blah 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 blah. But you look at it, and then again, coming in from holiday, I look at the prices and I see things like euro dollar. It was 118 when I left, and it's 118 when I sit down this morning.
Right.
Been on a bit of a walk, but you think, okay, what's changed? Nothing's really changed. We had a bit of movement around, but at the end of the day, things are still the same. The timeline is still the same for tapering. We're looking at maybe September FOMC for announcing it, or November or December, and that's the same position it was 2 weeks ago.
But here's the difference, Ryan, and this is what when you say, okay, well, I left 2 weeks ago and here I am 2 weeks later and we're basically at the same price. Here's what you missed, though, and this is where for us that's been in front of the computers and watching, this is the price action that you missed. Is the euro actually had a false breakdown, and the dollar actually had a false breakout a week 10 days ago, because it was Friday after Friday at the end of the week. We closed right at the breakout point, so last week confirmed a false breakdown, confirmed a false breakout in the dollar or a false breakdown in the euro. So that's the one thing that I'd have to say, coming back, of course you go, well, the euro's at the same spot that it was, but what you didn't see, and which I do think is very important, is the euro sucked a lot of shorts in and the dollar sucked a lot of longs in. Right.
Oh, 100%. And that's the sort of stuff that I now have to do over the next couple of days, is look at the charts and see what happens, see where the new support levels have come in, see where, see how the market's changed. But, it's like you first want to get an overview of what's gone on.
Right.
And, this was one event, one episode. So that's where I put that price action into, where are we afterwards? We're pretty much where we are going forward. But yeah, I'm 100% interested in what the euro did, what Canadian dollar did. I mean, that zoomed up 129s. That was I was long at just under 125 as I came into my holiday. I thought I did well getting out at 126.50 on the following week. I come back and I've seen it's been up to 129 and back.
Yes, I know. It's like, and where it tested, this is really important. One of the things that you would have missed here is we actually tested the lows from back in January 2020. So, I mean, that spike up to 129 and reversal was pretty big. And, and without getting the confirmation from Powell last week, without getting, and this is, I went into Powell's speech long the dollar. I went in long dollar Canadian, which I picked up at 125.80 earlier in the week. And, I was up at one point and I booked some profits up 120 pips midway through the week. And then, bringing my stops to break even on the remainder of it, I'm like, I was obviously let down because I took a loss on Norway, and I took I think break even or slight loss on the dollar MEX, and then I made money in the Canadian overall. But for all intents and purposes, I basically broke even at the end of the week because I was I was swinging for the fences, and we all. When I say swinging for the fences, I mean I had dollar longs saying if Powell's actually hawkish for once, I was going to do really well. But how many people were really disappointed at the end of last week? I'm sure a lot of dollar bulls anyway, And so now you got a lot of people that if they played into that dollar, strength. I mean, look, what happens to the dollar Canadian if we break back below the 200-day moving average? That's pretty bearish.
Down to 124 or something like that, aren't we? That's the market. It's, you always get expectations both sides, and then people take a slap like they did. Dollar longs get a slap, and then they're thinking twice the next time around. But what'll happen? The expectations will rise again into the FOMC. Was it 21st, 22nd, or 22nd?
22nd, of September.
And the expectations will come in again, and everyone would expect this, and then maybe we'll get disappointed again, and then they'll be back in October or November, and but that's trading. And we look at the levels, and that's why we look at these levels. I mean, I've got the same lines on my chart up at those 129s. It's easy to stay sitting here now that I would have liked to short into there, but those are the big, huge levels that you like, multi-month, multi-year levels.
Yep.
Those are the juicy ones.
They are.
But as you say, if you don't get the breaks of those levels, you're staying in the ranges. And like you say, if we don't hold up here, if the disappointment carries on, I think if yields get back under, if 10s get back under 130, we're going to start seeing a dollar weaken again more. And like Dale said, you might get your 119 in euro dollar and things like that.
Yeah, and I one of the other things I've got to point out here too, and then I want to hear from the other two guys that have been on holiday, Steve and Stelios. Are you guys here this morning?
Yes, sir.
Yes.
Hey, and is that Steve's voice?
That's me.
Oh man, look we got a whole crew here today. I'm
full house.
I must say, Dale and I, we had fun together, didn't we, Dale? But sure didn't miss hearing these voices, right?
I missed him.
Yeah, of course.
We still had fun though.
You big sappy baby. Anyway, no, I want to point out a couple of things.
I'm consistent though.
You are. That's good.
Baby.
The one thing that I wanted to point out is these yen pairs. I mean, look, the let me get rid of this really quick. The dollar yen we have stocks obviously moving higher. Yields are trying to, yields are consolidating, but look at like the euro yen's broken this descending channel. You have the even the sterling yen, the guppy looks like it could actually start breaking higher, but like the Aussie yen, we're backing up against a major trend line after a false breakdown. New Zealand yen had a false breakdown as well. I guess I should go into a daily chart which would be more important. You can see this false breakdown here. Aussie yen had a false breakdown below this key support. Canadian yen, we have a nice head and shoulder pattern, but I think a lot of people got sucked in on the short side, on this little false breakdown here. So yeah, we still have a head and shoulder pattern that we're developing, but I don't know why we can't, rally back to 89. So you got all this, you got all these yen pairs that actually look like they could play some catch up with risk assets. So that's another thing that I think we all need to be paying attention to. They tend to follow risk. But anyway, Steve, Stelios, what do you guys think about PAL? I mean, Steve, I saw your comments on Twitter about PAL.
Mine or Steve's?
Mine.
No,
yeah,
Steve's.
Steve's. Yeah.
Steve's.
Yeah, of course I wasn't surprised. I was a little bit surprised, meaning I didn't expect him to be that dovish. I expected him to try to keep, the balance exactly where it was, which was anyhow very dovish, but I didn't expect him to try to push in the dovish direction even further, as in my opinion he did. It was an unexpectedly dovish speech, in my opinion, and that's not easy. That's not easy in the sense that, yes, we know they want to be dovish all the time. They know that this is the only fuel that gets the market going.
He wants to be renominated, Steve. What do you think?
That can definitely play a role. I have no it's
a good gig, right?
No objection to your comment, Dale. Yeah. It is very likely that's part of the the issue
talking
here.
To Yellen.
Yeah, exactly. It would probably have been much easier for him to be a little bit less dovish if it wasn't for his nomination coming up, if he gets nominated.
Yeah.
But in any case, I think it might be a political issue, by the way, because I don't think that replacing Powell will make any type of a difference. But in my opinion, that's my personal opinion, it might be just a political issue, because don't forget that he was nominated under Trump, right? And he did all the favors for Trump. Not that I believe he wouldn't do the exact same thing for whatever government was in place. So in my opinion, it's, at a big extent, this might also be a political issue, that he's a little bit, let's say, tainted. The word should be. So in any case, I do believe that this opens the door for, a continuation of the status quo, which is what? Dollar weakness. I think this might have signaled the top of this corrective move higher for the dollar, and the continuation higher for equities that don't seem to, Go ahead, Blake.
Oh no, I was going to say, all right. Well, did you think that might have been it for the corrective move in the dollar? Stelios, did you have anything that
It
you
is
wanted
a little
to say?
bit early
I
to be
mean,
sure, but I think I think it's a decent likelihood that's the case. Yes.
so okay, all right, very good. And then now, Stelios, we've got a few minutes before Dale does his interview, so I wanted to make sure that you had an opportunity to
Yep.
say something here.
Well-
So what do you think? I mean, and by the way, I have to say that following Fed Chairman Powell's speech, gold finally broke the downtrend line, and gold finally, firmed up. When we might have a double bottom here in gold, by the way, and then silver finally climbed back above $24, which we, had capped us literally for the last several weeks. So, you got precious metals that are even starting to play along with this, believing Powell. So what are your thoughts here?
Well, I was surprised to hear Powell being dovish, a little bit surprised. It's, I've been saying for a while, we need to get rates higher, yields higher, for us to see proper two-way action. So equities, I think, will continue to grind higher. Unfortunately, I'm saying this because we do want two-way action. On the other hand, I'm happy about Powell because, as you all know, I am long metals and some minor stocks and everything, and I want to add more. I would have loved to add lower, but these, barring any disasters, any COVID-like black swan events, I think everything's going to go higher, unfortunately. So
it's going to be, everything's going to participate in the everything rally, right?
Yeah, exactly.
Right?
And you know me, I look at things a little bit longer term, and I take a few steps back. And as long as funding and borrowing is this cheap, what are people going to do? Where's money going to go? Well, it's going to go to equities or risk assets in general. So I see, as long as we see yields being this low, and with the Fed not being hawkish. I mean, they said that they're going to taper at some point, but hiking rates is now going further back into the future, further out in the future. So as long as the Fed is not hawkish enough, I don't think other central banks, at least not the big ones, are going to follow. I'm going to stray off course from that. They're going to follow the Fed, and because why? Why would the ECB hike if the Fed's not hiking? So I see things being the same. I've been away for a week on some really nice holidays, and I was hoping to come back to some proper volatility, and unfortunately,
good luck.
It's not. So
yeah, exactly. So and by the way, Dale, is your interview here? Is Luke here?
He told me he is. I can't find him. I'm messaging him on.
Okay.
Twitter.
All right. I'll let you finish. I wanted to mention just a couple last things. I mean, with what you said, Stelios, and I 100% agree. I mean, look, Steve, maybe we will indeed get, what we had been thinking all along with the S&P is, maybe we get that continued rip up higher, the grind to the parabolic trend as we've been talking about. And, maybe all we need really this week is, like I said earlier to Dale, give us a number this week. Give us a jobs number that, isn't great, but it isn't horrible. And, let us create 600,000 jobs. Let us create 520,000 jobs. And everybody goes, yeah, well, we're creating jobs, but we still need some support from the Fed. And that'll further boost this everything rally, right?
Yep.
Yeah. Well, hey, I want to make sure we give a special thanks to Ryan, from the Forex Flow live team, who has now joined forces with us. But I know it's a holiday there, Ryan, but I also know you've been off, enjoying yourself for the last couple of weeks. So welcome back, and glad you could make it on today, where I know a lot of the UK is enjoying a bank holiday. And for those of you that haven't visited our webinar sponsor, please go visit. You can visit Pepperstone Securities, but visit Forest Park FX. They make sure that we can provide this free face webinar for you guys. As I've been mentioning to you, over the last last 6 months, I've actually finally been able to trade my own personal account again. And I'm actually getting cashback rebates. Now, you have the ability to either get cashback rebates or you can try to qualify for Forex Analytics for free. You don't get both, but make sure you open your account with Forest Park FX right here through this link. You have, if you're, especially if you're outside the US, you have a lot of different choices of brokers you can choose from. And if you have any questions, just you can talk to them right through here. There's an email. It says brokers at Forex Analytics. The people at Forest Park FX actually return emails from that email address, and you can talk to them live on Skype right here. So make sure you visit our webinar sponsors. I want to thank you because, hey, I'm getting cashback rebates, which is kind of cool. I actually get a snail mail check, which is so weird to me, but I almost threw away my first check. I almost threw it away. I mean, that's what happens, right? You get all this this mail, and a lot of it's it's junk mail. And I got this check, and I'm like, oh wait, we should open that one, and lo and behold, it was an actual rebate check. So anyway, Dale, did you find Luke?
I'm going to ask Luke. Luke says he's here. I don't see him under attendees. Can you please, Luke, send a message in chat? Let me see what name you registered under, or did you call in? I'm trying to figure that out. So let's see.
Okay, we'll let you.
Hold on. Sorry.
What's that?
No, I am there. Oh, I don't want you to call in. Luke, if you're here, just let me know. Raise your hand or type something in chat.
Somebody just wrote, use the force, Luke.
Way to go,
nice.
DJ.
That's nice one.
Good one. Sophie's here.
You guys
see him?
No, I don't. I just started looking.
Maybe use forest from the trees.
By the way, while we're waiting for Luke, the joke where there's Luke Skywalker and Obi-Wan Kenobi are at the sushi place, and Obi-Wan is really good with the chopsticks. Luke is horrible, and he's trying and everything is just falling over everywhere. So Obi-Wan goes, Luke, use the forks. The forks.
Forks. That's good. That's funny. I'm still looking. Sorry, guys. I'm just Luke, if you're here, actually, what you can do is go into the chat or the Q&A, either or, and just make sure you say something, type something in the chat on Zoom or the Q&A, and then we can actually identify you and then bring you over, unmute you and that type of thing. So I'm looking around. I don't see him.
He says he's in.
Yeah. And he pinged you on Twitter, correct?
Yeah, he sent me him. There he is.
You see him?
Yeah. Okay.
All right. All right. Well, I'll let you take it from here. Stelio, Steve, and Ryan, great to hear your voices again. I hope you guys had a great time away, but I know Dale and I, we missed you. We missed you all. So it was good to have you guys back. And I'm going to let you take over from here, Dale.
Thank you.
Cheers, guys.
Good hunting, guys.
Bye-bye.
Ta-da.
Hey, Luke, I'm trying to promote you to panelists. Maybe I could do it now that.
And by the way, as Dale's doing this, I just want to tell you guys, Luke is probably one of the sharper guys on financial Twitter, and one of the better economists that you're ever going to hear. So you guys have to stick around. I can't wait for this interview. So Luke, thanks for joining us today. All right, I'll let you go, Dale.
All right, thanks, Blake. And Steve, can you help me promote Luke? It's not happening for me. If you're still here. I don't know why.
Steve? Oh, there he is.
Hi, Luke. How are you? Well, Luke, I'm going to ask you to unmute. How are you? Hi, Luke. Okay, now he's muted again. Unmute, please.
Unmute.
There you are.
There I am. Perfect.
Hi, how are you, Luke?
Good. How are you, Dale?
Good. You know, I looked, and the last time we talked was 2017.
There
It's
we
a
go.
long time ago.
You know what? Sorry, I just it bumped me out for about 5 seconds there, so I missed
Okay.
the last 5 seconds of what you said.
Yeah, the last time we talked was 2017.
Is that right?
Yeah, so I checked it out, and so what has been the biggest event in your opinion since we last talked in 2017?
Oh, that's a very good question. I would say it's probably two things in succession. I think the first was the repo rate spike in September of 2019 that forced
Okay.
the Fed to begin growing their balance sheet again. And then
Yeah.
I'd be remiss if I didn't say followed up by the COVID crisis in March of 2020 and the Fed response to that.
Yeah. Okay. All right. And so now we're all up to date. And you did it in 2 sentences, very efficient. And now I want to ask you, Luke, tell us where the forest is, because we're all looking at trees. We're all looking at COVID numbers, employment numbers. When's the Fed going to taper? So everyone's really looking at individual trees, and I want to know where you think we are in the, looking at the whole forest. California's forests have burned down. There is no forest. You can't find trees or a forest in a lot of areas here. So,
Unfortunately.
and I did go to your, your series. You send out videos to new subscribers. I subscribed, and I remember your thesis about negative real rates being the key, and your thesis and narrative that everyone thinks that negative yields right now are extreme until you bring up the World War II example of where they were here in the US. So you're still on track for much lower nominal rates and real rates that are going to move towards where we were in World War II?
Yeah, I think it's a great way of framing the question where's the forest, and with everyone looking at trees, and I think that's exactly where the forest still is, which is people say, Luke, I need you to tell me your thesis in 15 seconds or less, and it's real rates bottomed last August on the 10-year at negative 1.1%. Negative real rates are just nominal rates minus the rate of inflation. And that was consensus, was that they had bottomed and that this was going to be a typical recovery as we've seen post-war. And certainly in the last 40 years. And our view is that real rates likely are going to need to go in the United States at the 10-year level to -5 to -10%, and possibly even further is the big picture. And then you get into the why, and it's simply the levels of debt. There are so many things, so many factors that are different now than they've been for 40, 50, 60, 80 years. But most investors and most traders are still assuming the same playbook that we've had in the 2010s and the 2000s and the 1990s and the 1980s. That I think is the big picture. Is I think we've never really seen anything like what we're seeing before, but the analogs that are closest are, like you said, in the mid 1940s, immediately after World War II, and maybe in the 1920s as well.
Okay, so we had deflation in the 20s, and your point about the debt, since you and I last talked, that has risen exponentially, especially after COVID and all the rescue legislation and supporting individuals in the economy because it was no fault of their own. That was their whole, there are a lot of things that aren't our fault that cause hardship in people's lives, but first time in U.S. history, people have been kind of compensated for it. So does that exacerbate what you were talking about pre-COVID with all the new debt that's come from COVID rescue plans, the fiscal stimulus that we've had in the last couple of years?
In a word, yes.
Yeah.
When you look at, for example, in the 1920s, which was the last time you had what I would call a global sovereign debt bubble, you had the sovereign debt of the six biggest industrial powers of the time: U.S., U.K., Germany, France, Japan, and Russia. Over the ensuing anywhere from 2 to 12 years, fell in real terms against gold by 60 to 100%, with two of those six hyperinflating their currencies to basically zero, being the Germans and the Russians. And obviously there's political issues to go alongside that. But I think when you look at your question in terms of how we reacted to this crisis, I think it's important from two standpoints. Number one, your summary is exactly right, and I'll probably be borrowing that in future conversations, because I think it's a brilliant way of framing it, which is hardships have come and hardships have gone throughout human history, but this was really one of the first times where people were compensated for hardships out of their control. For example, in the Dust Bowl in the 30s, and there were no compensation. People packed up their cars and took what they could and went to California. And so this time we did. And so that, again, kind of alludes to my initial point that we're seeing things we've never really seen before. But that then also ties into the second point, which is when we look at the 20s example, the United States in the 20s and 30s did have deflation until we devalued the dollar against gold and began deficit spending under FDR. Then we went into World War II. That's always inflationary. So, but another way that I think people are misapplying history, and many investors and traders are misapplying history, is the United States was the world's biggest creditor at that point. We were in a role that is now occupied by China. And the role that the U.S. Occupies is more like Germany, England, France, kind of rolled up into one after World War I, where we do have the global reserve currency. The UK had it then. There were challenges to it then. There are challenges to it now. Those countries were deindustrialized by war. We have been deindustrialized by trade policy over the last 25 years. So there's some things that rhyme, but when the bottom line to it is when you put factor one, which is this is the first time in recorded history, or certainly in a long time at the very least, that we are compensating people with future debt to pay them now, to compensate them for hardships out of their control, combined with the fact that we are in this debtor twin deficit position with financiers who are no longer buying enough of our debt or outright friendly. It sets up a very structurally inflationary / weak dollar period, because ultimately it sets up a period of time where the only financier of debt, the biggest marginal financier of U.S. deficits, is going to have to be the Fed.
Interesting. And let me ask you this too: is there a similarity with, although it's not being caused by war, although some people would say we're in we're in World War III, it's a Cold War right now with everyone, but were there supply chain issues similar in World War II, where we had to turn American citizens turned in rubber and different materials so they could use it for making arms and things that our Army could use and our Marines could use? So similarities with supply shortages. Is that another similarity with World War II that we're having now, not because of war, but supply chain issues?
I think so on some level. I think similar to World War II, similar to World War I. I think the World War II example is a really good example of what happens when you have to supply yourself, and that's something that's really been forgotten, I think, by most Americans, because, to be blunt, most of the Americans that lived through that at an adult age are dead, and so they're gone. I remember finding the old ration stamps in my father-in-law's when he passed on a decade ago. They were his mother's ration stamps from World War II, for, just like you said, for sugar and for cotton, something else, gasoline. Right?
And people forget because they're so cool, woodies, right? They forget that it wasn't just by design; it was by necessity.
Yes.
That to use less metal to build a car, they started using wood paneling on the side of some cars.
Oh, I didn't know that. Oh, interesting.
Yeah.
Oh,
the
that's
woodies.
interesting.
So
That's a great
go
point.
ahead. Yeah.
No, I was going to
we'll
say
throw our surfboards on top of it.
Yeah. You can make anything cool, right? I mean, when cotton prices got really high, 5 or 8 years ago, all the dress shirt makers came out with the new light cooler style, right? Of like, hey, they were selling it to you as if they were doing you a favor because it was, more breathable cotton. But the reality was cotton had risen so much that, a shirt was going to be $50 and they weren't going to be able to retail it across most of the country. But no, it's this. We are so, as Americans, having the global reserve currency as it's been structured for the last 50 years, we are so used to dollar equals goods. We've never even had to give it a second thought. And there's never been this, I have dollars, where are my goods? And we're, for the first time in at least 50 years, and probably more like 80 years to your point during the war, I have dollars. Where are my semiconductors? Why can't I get my car? Why can't I get my chicken at Chipotle? I think
everything.
It's a signal. Yeah.
Everything. I mean, Americans are not used to shortages. And I've ordered a few things online and had delivery dates, and then delivery dates were postponed because they didn't have it in stock, and isn't it also our we don't stock inventory anymore like we used to. It's like as needed. I forgot the term.
Oh, the just in time. Yep.
Yeah, just in time, and now just in time is not enough time.
It's exactly right. No, it's exactly right. And I think too, some of the you've not only stretched supply chain, so you've taken inventory out of the system, you have taken inventory out of the system by concentrating warehouses, right? So Amazon has, I don't know what the number is, 5 or 10 major warehouses that are sort of their big ones around the country. So they've consolidated, all in the name of efficiency. Everything has been in the name of efficiency, but it's not been in the name of resiliency. Because if you're looking at a scale, you can have really, really efficient, but then you're going to be not resilient at all, or you can be really, really resilient, or you're not going to be efficient at all. And so we used to have a balance, and I think the original Cold War with the Soviets helped force us to keep that in balance because we needed to be able to make stuff ourselves just in case.
Yeah.
And over the last 20, 25
But when China
years,
came in, that changed.
So we stretched our supply chains out, and we went hard to the side of everything for efficiency. And now we're finding out we're not very resilient. Even, for example, in our domestic industries, we have consolidated our protein processing down to shockingly few plants, to the point where when COVID hit last year, there were periods of time where there were meat shortages because the workers had COVID, and there was only, Tyson only has 5 plants or whatever it is throughout the whole country. And so you run into these spot shortages. You saw it with lumber with some of the processing capacity as well last year, which contributed to the run up there. So it's the supply chains are very fragile.
Yeah, and we don't, because we don't have the manufacturing base you said. Most people don't realize that if on our power grid, some of these huge transformers that we have, we don't make them here. They're made in China, and if one of these blow out, it could take multiple months and maybe years to replace it from China. And that's if relations are good.
And that's if relations are good. That's if COVID's good. And I think that's another sort of big forest that people in the trees in this debate of inflation or deflation or inflation, deflation. To me, it's a fascinating cognitive dissonance in many traders' minds and investors' minds that, point A they start with in their mind is we're going to get tougher on China. This is a Cold War. And I think that's the right point one to start with. But then point 2 in their minds is we're in a secularly deflationary time frame because too much debt is deflationary, and that they are forgetting the real world connection between debt and real world goods and fiat currency and real world goods. And if you're going to pick a fight with your biggest supplier, you're going to have shortages. And when you have shortages are never, ever, ever deflationary.
Right. And it either is, higher wages.
No, and we're
That's
seeing
not
that pass through, too.
transitory. You can't give someone a pay raise and then a pay cut.
Well, and the usually not. No, the private sector can lay people off, or the private sector can do some things to manage that. To me, what's been particularly interesting in recent months, and this has been part and parcel to the steps we have taken to ease the hardship out of everyone's control, is the U.S. federal government is almost 30% of GDP. If you look at annual spending of the U.S. federal government relative to GDP, it's all-time highs. And what we're seeing now are wage increases, big wage increases coming from the federal government to their employees. And people say, well, high prices cure high prices. And that is true with one exception, which is high prices don't cure high prices for the federal government when they can print the currency. They'll just print more. Right. And they will then chase inflation, wage inflation, goods inflation. The government unless the US government is willing to shut itself down for lack of goods, then high prices won't cure high prices. High prices will just feed on themselves, because the federal government at 30% of GDP will not let themselves get shorted for lack of printed dollars. So I think we're in this very sensitive area now where you're seeing all of these factors we just discussed more frequently. And they're sort of stuck from a policy standpoint as a result, where you can delay paying. I'm sorry, go ahead.
Yeah. Are you familiar with that milkshake theory, which dollar bulls use, that before the dollar falls apart, that there's going to be this huge demand for dollars because of emerging market debt, et cetera, that's going to create a liquidity squeeze and drive the dollar index up to 120 before the collapse. Can you see any way that we could have that one move to, because I would say that most people are fundamentally bearish a dollar for pretty obvious reasons, and very few bullish a dollar. People are embarrassed to come out and say they're bullish a dollar. Do you know what that milkshake theory is again?
Absolutely.
Luke?
Yeah, absolutely. So it's effectively that there's so much dollar debt outstanding that we're basically a giant short squeeze of the dollar in sort of the last, in crisis. And we've seen that play out in I would say for brief periods of time.
Right.
For example, last March of 2020, where we saw the dollar spike up to whatever it was, 102 or 103 on the Dixie at the time. And I agree, it could still super spike. I think increasingly as we look back in time that March 2020 was the super spike. And the reason I say that is, and a reason why I have always had a healthy, friendly debate with my friend Brent Johnson, who was the original espouser of that milkshake theory, has been, I remember a friend of mine asked me, Luke, how can you be bearish a dollar with so many people short dollars? And basically, hey, how can you be against the milkshake theory? I said, simple, there's nobody more short dollars than the US government, and they can print dollars. And he just paused and said, oh my gosh, that's exactly right. And that's why, and we saw it in spades. So my view was, you could see that dollar spike. I don't know where it could spike to, but at some point along that spike, what's going to happen is US markets are going to crash so severely that you will start to see treasury yields rise in a US stock market crash. And at that point, the federal government will step in, the Fed will step in and do whatever it takes. And that will be the end of the dollar super spike. And I think most people thought that would happen at 110 or 120. I thought it would be much sooner. And what we saw in March of 2020 was that Dixie got to 102. The S&P was already down nearly 20%, which was more than I thought it could fall before this would happen. But beginning on March 9th, 2020, Treasury yields started rising rapidly as stocks were melting down. And so from March 9th,
until the Fed stepped in,
till the Fed stepped in. And so to me, that's why I say, I understand the theory, I agree with the theory, but I increasingly think as time goes on, that March, that March 2020 was the super spike, the 102 to 103. Now, to be clear, at any given point in time, we could still get that. So if we use an extreme example, if the Fed came out tomorrow and said, we are going to take our $8.2 trillion balance sheet down to zero by Christmas 2021, and we're also going to raise rates to 3%. I guarantee you the dollar's going to a lot higher than 120. And I shouldn't say I guarantee, but it is highly, highly likely that the Dixie's going to 150 or 200. So that theory is always on the table from a purely economic standpoint. Now, my point is when you blend the political economy with the pure economics, it seems highly unlikely, because the flip side of that is the Dow's probably going to, I don't know, 5,000. The S&P is probably going to break the lows of 2008, et cetera, et cetera. And that's a problem, because that's basically the economy at this point. The S&P, the equity market cap at 200% of GDP, where we are in the United States right now, means the stock market effectively is the economy. So you basically, the economy would crash. The U.S. economy would crash, stocks would crash, global economy would crash, dollar would be up a ton. But I think politically, that's not really on the table anymore.
Okay. That's interesting. Do you think that perhaps, and I look at the dollar and, I'm kind of in agreement with you now. We've had this nice little bounce here from the beginning. Everyone came into 2021 very bearish a dollar. Do you think this little bounce sideways move has been enough to shake out dollar bears, or could we pull back and maybe make a rally back towards, I know you don't make market calls, but could this dollar, let's just call it stability, carry on for a bit longer before we get into an acceleration phase on the downside? And do you think Powell is going to be renominated, or is Yellen going to push for Brainerd? And is that going to be really the key? I mean, Powell sounded like Brainerd Friday anyway. So is that also part of Fed policy? Is Powell wanting to be renominated next year?
Yeah, so on the dollar, from the short-term perspective, I think a lot of it comes down. I think they would like to keep it stable for the moment. And we've kind of seen, I don't know, if you map the cadence of Fed governors against where the dollar's traded, once it gets up into 93 plus, we got into 93 and a half or whatever, and all of a sudden you get Kaplan, who's been a pretty hardcore hawk, saying, well, maybe I need to, and so I think they are trying to manage it in a range that is creating stability elsewhere in the markets. And I think that range is probably, it seems like it's, between, call it 91 and 93.
Okay. Yeah, I think we could pull back to 91 here over the intermediate term and then make one more run, kind of have something like this from a lower level that lasts, maybe into October, end of the year. How does oil fit into this mix? Same type of thing. We're going to run into shortages. What a change a year can make from, that having negative prices for crude on that technical futures situation to, do you see any global slowdown that might ameliorate some of these commodity prices that have already had tremendous runs, like copper and oil and agricultural commodities? I mean, the Fed can't print corn. So
no, they can't.
What are you thinking here with the commodity complex?
I think the commodity complex I think it's really interesting on two fronts. So I think you have to look at the policy front, where in the short run, we've got some political hiccup as it relates to debt ceiling and stimulus and whatever. But ultimately, the big gear to this thing is the U.S. needs to inflate its debt away, as we talked about at the start of the show. And so you've got, they're going to have to spend a whole lot of money. The Fed's going to have to effectively monetize a lot of that, or else it causes as many problems as not spending the money at all. And that's a really good monetary background for these commodities. And then when you layer in particularly certain commodities like oil, a lot of the metals, I think behind the scenes, there are some growing supply demand problems in oil in particular, but I think more broadly as well, where there has been in a lot of the metals underinvestment over the last 5 to 10 to 12 years.
The mines.
They've been so burned by what has happened. And I think in oil in particular, if you look at the global production, there's been very little marginal production of oil other than U.S. shale since roughly 2005 to 2006. And we're now running into problems growing U.S. shale any further without prices going much higher to incent that production. And so I think there is both a monetary and a really a structural, supply support for higher commodity prices, starting with oil. And once you start with oil, oil's really the master commodity to them all, right? As energy.
Yeah, it's in everything.
It's in everything. That feeds into everything.
You
so
even need it to make the green economy start up. You need it for everything.
That's exactly right. I always joke around, if you give me enough oil, I'll grow you 150 bushel corn in the parking lot of a Walmart.
Yeah.
So.
I want to wrap it with what do you think about, when I look at 10-year yields here, longer term, Luke, and that there is, unless we do get that stock correction, I could make a case for, maybe 210 on the 10-year if we come out of here and maybe have a good number Friday. I'm not sure what's going to happen, but is this going to be a great buying opportunity in bonds if yields head up to say 2% on the 10-year? Is that a buying opportunity with notes as we start to head back down towards negative, lower negative real rates, according to your thesis?
Well, for me, I think bonds from an investor standpoint, I would be, we just went through a structural underweight simply because I think that they're going to have to inflate this debt away. And I think from a trader's perspective, I do think that I think it's a market where the Fed wants to make it appear like they are not managing that market while managing that market. And they have done as we saw yields looking like they were going to break out back in April. We saw a great job of all of a sudden talking about, hey, taper might be on the table. And you saw this quarter of jawboning from the Fed, quarter plus of jawboning. I think they were pretty panicked as they got to April. I think they were surprised by how fast and how successful they were at generating inflation by monetizing massive federal deficits.
And they forgot about the bond vigilantes that are out there. It wasn't them that took yields from 50 bips to 170. So it was the market that did that, right?
Market took it on them, and I think that surprised them. And it's challenging because I've always joked about this as the, describing the Fed trying to ride two horses with one rear end, which is they need to inflate the debt away, but they need to convince the bond market that they're not going to inflate the debt away. So for me, I wouldn't be surprised actually if that 1.7 range isn't the line in the sand on the 10-year in terms of when, where I won't call it yield curve control, but yield curve control-esque behavior would escalate. So far, they've been able to do it with jawboning and with some of the things they have done in terms of just with what's happened with the stimulus rolling off and what have you. But again, it's those two opposite needs. The U.S. government needs to get the debt down to get it to a level where the debt is sustainable for the Fed to normalize policy. But to do that, it needs to financially repress these bondholders with these significantly negative real rates. So to me, that's I'm watching in the short term from a trading perspective, just what happens with the debt ceiling, because as you remember from 2011, if we get a bunch of drama with that, you could see yields go lower first. But I think the 10-year is really increasingly going to be basically a managed market. I think that's where we'll see a Japanification is in the 10-year over time.
Yeah, so they've taken the bond market away to central planners.
Yeah, unfortunately.
From us.
Yes, unfortunately.
Those bastards. Oh, excuse me. Anyway, Luke, great interview. It's really, I enjoyed talking to you again and hearing your, hearing where you think we are with the forest. And, here's your website. I just want to show it to our viewers and attendees and people to watch a video later. And you do offer, some nice videos that explain what you and I have been talking about today. So I encourage people to, go to Luke's website right here, fftt.com, right, Luke? With a hyphen LLC, yeah. So we have to get the tax classification in there too. So Luke's Limited Liability Corporation. Good time to have limited liability into this financial world right now. So thank you so much, Luke, for coming in and sharing your views and giving us some of your time today to edify our community. Yeah,
absolutely. Thanks for having me on, Dale. It was great being here again, and apologize, I was a little late getting on technical difficulties on my end.
It's great. I'll be in touch with you, and really appreciate you sharing views a lot, that make your research pretty unique. I really think that some people had their eyes open today. So thanks for doing that, Luke.
You're welcome. Thank you.
Okay, everyone, you could join the team in 10 minutes on the Morning Edge. See everyone tomorrow for Turnaround Tuesday. Here's Luke's website. Check it out. And remember, don't just count your yields, count your blessings. And we'll see everyone tomorrow. Adios. And thanks again, Luke Groman.